It's very nice to see everybody up in the morning as well. I think we are getting towards the end of the tunnel. Hopefully in about 2 weeks' time, we can see each other in person. And it's always nice to have this kind of meeting in person as well, to have that interactive session. So this morning, what we're going to touch a little bit about is fundraising. Fundraising from your end, once you step onto that entrepreneurship journey, it's fundraising is never fun. That's number one. Number two, that's a arsenal of actually financing instruments that you can actually tap on, and I've listed them on the right hand side as well. In the middle there is actually a very unique debt financing instrument that some of you should actually get a lot more acquainted with. It's a lot of companies actually tap on to debt financing, whether it's venture debt or growth debt at the end of it. And I'll explain a bit later on about what it is, right? So we're going to touch a little bit about how venture debt and growth debt can be a very useful, financing instrument throughout your whole venture-backed career. And the reason why we started Southeast Asia's first private venture debt fund is because we saw opportunities on both sides, right? So on one end, the investor side, right, the family office, the high net worth individuals, and we believe, right, that financial institutions like banks would actually be very keen to work with a fund like us, right? So having worked in the bank, we realized that actually there's a lot of corporate red tape, right, that prevents us from doing a lot of the things that we want to do with venture debt, right? So having a private vehicle and being funded by a financial institution might actually help to alleviate some of the challenges there. We are a MES regulated venture capital fund manager, and in March of this year we closed about $80 million. We are fully dedicated to venture debt. We don't invest equity at all. A lot of the entrepreneurs ask us why, and one of the reasons is because there's already a lot of the other venture capital equity partners out there, and we are one of the rare few that actually do just purely venture debt. Our focus is Southeast Asia. We are a venture lender, but we are also a committed impact fund as well. So as a lender, and if you look back at the history of lending, right, a lot of the banks and the financial institutions have actually done a lot for the impact side, ESG side as well. And we're thinking, why not? As a venture lender, we are able to actually touch some of the startup companies here in Southeast Asia, and we have a few examples to show that, right? So almost half of our portfolio companies have some committed impact angle as well. So let's jump right in, right? Let's jump right in and talk a little bit about venture debt in a more mature state. So venture debt in the US really has been around for quite a while now, right? It's been around for almost 5 decades already and counting and growing very strongly. And some of the big names that you see out there, right? Airbnb, Spotify, Facebook, and so on, have really raised both venture and growth debt. Right. And in fact, if you think about it, Airbnb last March, right, when COVID hit shores, they actually went out there to raise roughly about $1 billion of growth debt, right? And the growth debt helped the company to tide over the very challenging situation of the COVID and allow them to actually file for an IPO. And both the equity and the debt guys are happy because their investment in the company actually yielded them a very good return. So if you look at the bottom part of the slide, right, these companies have raised a combination of both venture equity and as well as venture debt as well. And a lot of them have demonstrated the success of what a tech company can be. And then on growing their growth as well, they continue to pile on more financing. So still talking about the US, it's already a very mature market, but still we're seeing signs of very nice growth in the United States. In the chart in the middle there, you will see that the brown bars represent the equity side, so the VC's investments into the tech companies. And then the blue bars actually represent the venture debt proportion as well. So if you look at the last 4 or 5 years, right, venture debt has been growing steadily. Alongside that, the equity side has always been breaking, fundraising records. And last year was quite surprising because everyone thought that 2020 would actually be a whitewash, but it ended up as a very a good record year for both the VC funds as well as the startup that were out there raising money. If you look at the blue side of the bar, right, from 2017 onwards, we're looking anything above $10 billion of funding, right, up to 2020, where there's about almost 25 billion, if I'm not wrong. And if you add them all out, right, across the last 4 years, there's almost $100 billion of venture debt invested. So this is something that most people will not be familiar with. A lot of people think that venture debt is actually a very small market. As a proportion of venture equity, it is smaller. But as a proportion of the total financing out there, it represents roughly about a 20 to 30% debt to equity ratio. So moving on, coming back to somewhere nearer to this part of the world, we have been studying the growth potential of venture debt in Southeast Asia as well. This chart came from a report that Genesis and PwC jointly published about a couple of weeks ago. On the right-hand side, if you look at the chart, right, the red bars actually shows the Southeast Asia venture equity funding. That's where most of you here on this call today would be actually dabbling in the very early parts of your fundraising journey. And Southeast Asia has really gone through a very significant rise in terms of its importance to the tech and venture ecosystem. Right, it started from about 1.5 billion of equity in 2014, right all the way up to 2018 when it peaked about $12.6 billion as well. And then it started kind of plateau down to about 8 billion or so for the next 2 years, right? But just at the first quarter of this year, there was again another record fundraising quarter for Southeast Asia tech companies. Combined one quarter, they already raised 6 billion. So we are really excited to see how it will be for the next 3 quarters, right? Will it break the record that was set in 2018, or will fundraising slow down because of how COVID is actually evolving across Southeast Asia and in the world as well? So if you move on to the right-hand side of the graph, you will see that that is an estimated Southeast Asia venture debt addressable market, right? So we're not saying that there's this amount of venture debt that has been deployed, but if we look at the example of the US, right, the debt to equity ratio is roughly about 20 to 30% addressable market there, right? And applying that same logic into Southeast Asia as well, in 2014, there could be potentially about $200 million worth of venture debt that was injected into the market. But being a practitioner back then in 2015, I know that there's not that much of venture debt circulating around, because for a few reasons, right? One is that there was not a lot of awareness about venture debt. Most of the entrepreneurs, even some of the VCs, actually struggle to understand how venture debt works and what kind of advantage it can bring for their portfolio companies. But if all things being equal, if we think about last year, potentially there could be up to about $800 million worth of venture debt that startups can actually raise, right? So it's a huge market, right? That's why we started the fund. Genesis raised $80 million, and we're actively investing as well. So just as a summary, I guess venture debt history in the US, we have already almost seen about 50 years of it being in the market. Southeast Asia is still very young, with only about a fraction of that in this part of the world. But there's a lot of use cases of venture debt already emerging from Southeast Asia. Grab, for example, back in 2017, actually raised $700 million of debt, right, to grow their ride-hailing services here. right? So you might be wondering why, right? Why would they actually be using debt instead of equity? I'm sure SoftBank would be more than happy to give them that amount of money as well. But it's for a very particular reason, right? It's because Grab wanted to build a car rental business, right? They wanted to have a fleet of new cars, right? That will significantly improve the reliability as well as the quality of their ride-hailing services. And in order to do that, they have to make sure that the cars that the Grab drivers actually put out to the market is actually of a certain quality and something that they can actually control as well. So they use that and they raise what we call conventional debt, right? To provide additional liquidity for the company to go out there, because they don't really wanted to give out shares, right? If Grab actually raised $700 million of equity to buy cars to set up a car rental services, they would actually have to incur a lot of dilution for doing that. So let's come to the point about what exactly is venture debt, right? There's a lot of confusion out there in the market, and we continue to try and evangelize and educate the market about what venture debt is and is not, right? Venture debt is not convertible debt, right? So there's a lot of entrepreneurs out there that's very confused about convertible debt and venture debt, whether they're the same. Convertible debt, in a nutshell, gives you that opportunity to decide whether you want to stay as debt or you want to be converted into equity as well, right? So debt is actually much more quasi-equity than debt to me. Number two is not a collateralized bank debt, right? So there's no personal guarantee from the founders. We don't take director's guarantee as well. It's all secured against the company. And that frees up the entrepreneurs to be a little bit more, when they execute their vision with venture debt in their business, they're not really worried every day at the back of it, thinking that, they are personally liable for it. But I on that point, I would just have to say that the founders should still be responsible as an individual, as an honest human individual as well. And that's what we saw in a lot of the founders that have took venture debt from us, either at DBS or at Genesis. It's not for pre-revenue company. One of the key reasons is because venture debt is actually an amortizing debt, right? So basically you have to pay down. It's a principal plus interest amortization across the tenure of the debt, which is typically 2 to 4 years. And we are not going after the traditional SMEs, right? So we're not competing with DBS Bank or UOB Bank, who has already have like a 90% market share of most of the SME out there, right? So these are the key outlines of what venture debt is. Venture debt definitely is designed for venture-backed companies, right? So the way that we look at it is that there must be a VC fund that's already an investor or going to be an investor in the company itself. Okay, so that is a one criteria tick box that is a must-have. Right, it's suitable for tech or tech-enabled business model. So we don't really do companies that have, even though you have a venture capital fund backing, but your business model is very traditional, without tech or tech enablement, then that's something that we would strongly consider as well. It's definitely a leverage against the venture equity raise. And a lot of the what we call venture debt that's being raised today, it's against a financing round, and I'll show you in the next slide about an example of how this can actually be rolled out. Okay, as I mentioned earlier on, it's an amortizing loan with monthly installment repayment. And a lot of the founders says, why don't we do like a bulleted repayment, right? Well, the bulleted repayment, in a nutshell, is like sending you a bullet at the end of the loan tenure, right? Because at the end of the loan tenure, let's say, for example, if you have a $2 million debt that's actually maturing, what would you do? You actually have to scramble to raise money to repay the debt, right? And it's not easy to raise $2 million to repay the debt as well. There are situations that we have seen before that has happened, and it's usually not nice. It's definitely a venture debt is a debt that's accompanied by an equity warrant for the lender, right? So we do charge an interest for the loan. And alongside the interest rate is the equity warrants for the lender, and that's really the motivation for the lender to take that increased risk in the company, right? If you think about it, venture-backed tech companies, right, the ratio of the ratio of failures of these companies is significantly very high, especially in the Series A, B side, right? Series A probably about 70 to 80% failure rate. Series B 50 to 60%, right? So we are actually taking risk in companies by giving them debt, but it's also because we believe in a few things, right? We believe in the investors, we believe in the business model, and we see that there's a potential for the company to go on its fundraising in its later stage of its growth as well. So let's talk about an example of how to raise venture debt, right? When I talk about leverage against the equity there, is one of these two following examples. So traditionally, a Series B company raising 10 million in the top row example, they will go on to raise 10 million of venture equity. And just for discussion's sake, right, they gave up 25% of the company in exchange for the $10 million, right? So that's the traditional pure equity fundraising mode there. So if you look at the bottom row there, again, same company raising Series B funding, 10 million, no change to valuation as well. But instead, they raised 7 million of equity and 3 million of debt, right? And in exchange, for that 7 million of equity, they actually give up 20% of the stakeholding. And for the venture debt is entitled to 1% warrant, right? So effectively, the company is saving roughly about 4% in stakeholding, right? So imagine if you can accretively, take this dilution factor down the fundraising journey. As an entrepreneur, you'll be keeping more of the company yourself. The case in point here is really, you are still getting the same amount of dollars in the company. You're still getting $10 million, right? There's no change to any part of that equation. What about this, right? In exchange, some companies that we know and have raised money from us have actually gone on to take the entire $10 million. But now, on top of the 10 million, right, they actually have gone on to raise an additional 3 million of debt. Right? They still give up 25% of the stakeholding, but in exchange for an additional 3 million in the bank, they actually have to give up an additional 1% for the warrant, right? If they raise another 3 more million in equity, they probably have to give up another 4, 5, 6% of the company, right? So there are two ways of looking at venture debt. One really is to scale down the equity dilution, raise the same amount of capital, right, as in the earlier example here, right, where you keep 4% of the company for yourself. And then the next example really is going for that explosive growth, right? Having extra cash in the bank to allow you to tap on to additional growth, hire more people, go into an additional market, and then go on and win the market share from your competitors, right? And leave your competitors way behind while you lead the race. What does venture debt do, right? Venture debt essentially extend the cash runway. So in this example of a company, they raise Series A on month 4. At month 6, they complete their venture debt financing. They bring in an additional $3 million into the bank that allows them to run the business for another 3 to 6 months, right? Which in essence allow them to achieve a lot more on their key milestones, right? And once they achieve their key milestones, they can then go out on the next fundraising round to ask for a higher valuation, or can they delay their fundraising, right, so that they can actually go out to the market and attain better valuation for it as well. So venture debt, in an essence, if you use it appropriately, can help you to extend your cash runway and may help you to increase your valuation as well. So there are various uses of venture debt. The most standard one being the one on the top left-hand corner, which is term debt. And the main term debt really means is that it's given to the company as a lump sum. They can then use it for hiring people, for expanding their business into Indonesia, for example, if they're only operating in Singapore. Really is to defray some of the operating expenses. On the right, to term debt is working capital, right? So startup companies are no different from any SME corporates as well, right? They have accounts receivables, their customer pay them 90 days later. If you wait for the cash to come in, you may not be able to hire one more salesperson to help you to accelerate that growth as well. But imagine using venture debt, you can actually bring in the debt, the cash at T plus 1 day, right? And then use that money to actually grow that business further as well. On the bottom row, we're talking about inventory. Some companies need to buy stuff to make stuff, right? So supply chain financing, for example, production down payment. And at the bottom right-hand corner, I've written something that most people wouldn't have think about, right? It's really as an insurance buffer, right? Because as a startup company, things never go according to plan, right? The growth doesn't happen. What happens, right? You're out of money. You try to raise out money when the growth doesn't happen as promised, and then what happens? You have to do potentially a down round or a convertible debt to prove that actually you have to you can actually meet the milestones that you have set up. But when you raise that emergency funding as a last resort, it's usually very dilutive. And is usually very, expensive as well, right? So there are additional liquidation preferences that are stacked on top. When we've seen convertible debts with like 2 or 3x liquidation preferences, and that is very, very expensive for the entrepreneurs. So I came across this graph, which is very interesting because some entrepreneurs that we talked to, right, back in our early days and even today, thinks that the venture equity is actually free of charge, right? They say, we raise equity, I have the ability to raise hundreds of millions of equity. It's free, right? And, I spend it, once I'm up with it, I can just go back to my investors to raise more equity again. Nothing is free, okay? So everything on this chart has a cost to it. But if you look at from the right hand side, the cost of capital is the highest for equity because you're giving up your company's equity in exchange for the capital that you bring in. On the left, there's traditional debt, right? So that's the lowest form of the cost of financing. And if, right, and we always tell the entrepreneurs that if you can actually qualify for a bank debt, by all means, go get the debt from the bank, right? If the bank offer you a debt, right, at a reasonable cost, you should actually get it, right? Because that's always the lowest cost of debt as well. Then in between, you have the growth financing, right? You have factoring, you have venture debt as well. But I think the key word here is really the blended cost of capital, right? Because we're not saying that startup companies should go all out to raise debt only, right? Because debt doesn't fund 100% of the risk. Right? You need some form of equity in the company as well. But the real equation is really trying to blend that cost of capital so that you achieve the goals that you want to do to get with the same amount of capital, right? But with the blended cost of capital, adding debt to the whole fundraising instrument will allow you to achieve that, right? So I'm just coming to the last few slides that I have. Who have used venture debt in Southeast Asia? These are based on some of the guesstimates that we have. We think that there are about 100 VC-backed companies, from ourselves and also from some of our competitors as well. We think that there's easily a $300 to $500 million worth of debt already circulating and being used by companies, the 100 companies out there. So, just to finish off, how do you, think about exploring venture debt in Southeast Asia? Always think about starting an early conversation. We have, entrepreneurs on the ground who always say that I will raise venture debt when I need it. Right now, I don't need it because I have money in the bank. But, it's always a long-lasting relationship you want with the lenders, right? It's smart money that you want to have. And you should also understand how that works and whether if it's right for you and for your company, right? If venture debt is right for everyone, then we'll probably be seeing equal amounts of venture debt and venture equity, not just in Southeast Asia, but also in the US as well. Point number 2, really use venture debt to its strength, right? So you can raise equity for really innovating and coming up with new products and business services, but use venture debt for other reasons, right? Use it for flexible regional growth, for insurance buffer, because it's less dilutive, right? And use equity to leverage debt, not as a last resort, right? So don't wait until you have a last dollar in the bank account before you start talking to your lender, right? Always have that, build up that relationship with the lender, raise money when you don't need it, right? That's the the advice that I would give to all of you, and come to talk to us, right? I mean, as you start your fundraising journey, whether you're in seed, Series A, or pre-seed, right? We always want to have a chat with the founders to talk about how potentially debt could be in there. So when you understand what debt is all about, then you can actually structure it as your fundraising instruments as well, right? So our websites are out there. I have my QR code V card out there as well. And recently, my partner Ben just gave a podcast on what venture debt is all about. And if you have the time, please go and listen to it and get more insights about how we actually carry out venture debt. So, with that in mind, that's the end of my presentation, and I will open up the floor for questions if there's any.